Hi, everyone. My name is Thomson, and I am the head of data science for Square Capital. Who here has heard of Square? That was a dumb question. OK, so who here has heard of Square Capital? Fewer. Got it. Square, in case you don't know, I think a lot of people know Square as the little thing you put into your iPhone or Android phone, not your iPhone 7 now, but you put it into your phone, and then you swipe a credit card to take a payment, unless you have one of 70 dongles that Apple now has. You might also have seen this in a cafe or in a restaurant. This is the Square stand. You put it in an iPad, and you can turn an iPad into a point of sale and a cash register. And now our newest product is a cardless and contactless reader. So if you have a chip card, you can put it into the slot on the left. And if you have Apple Pay or Samsung Pay, you can just tap your phone. And so, Square was started in 2009 by Jack Dorsey and Jim McKelvey, basically for this express reason. Jim McKelvey was a computer scientist and a glassblower, and was trying to get a sale. And he was selling, I think it was like a piece of glass for $300. And the customer said, oh, I'll be right back. I'm going to go to the ATM, and then just dove off. And so he was super frustrated. And Jim and Jack were talking on the phone. They're like, gosh, I wish there was some way to just take credit card payments super easily. And they realized that the mobile phone that they were carrying is basically a supercomputer in of itself. And so if you could digitize a card signal into a digital signal, you can take card payments. And so thus, Square was born. And so the Square Reader started in 2009. And since then, it's really become this massive ecosystem of sorts. And so you can see in the middle column is the sort of Square we know and love. There's the register. There's hardware, such as the card readers I showed you and the Square stand. We also have on top of that analytics. We tell you how often your customers come in, what are the busy times during your day, so on and so forth. If you have employees, we have an employee management tool that allows you to schedule time cards and scheduling. Square Cash is our peer-to-peer payment system. You can send cash to people, much like a PayPal or a Venmo. Invoices, appointments, online store, app marketplace. And on the right side, you have marketing services such as customer engagement, the ability to send emails to people, and Caviar, which is our delivery company that we purchased in 2014. And that's basically if you want, I think they came from Cal. If you basically want to buy food, you can use Caviar, and then the processing is done through Square. So the left side is what I'm going to be talking about today, specifically that first bit, capital. Basically, if you are a seller on Square and you're taking credit card payments, at some point you're going to want to scale your business. And capital is a great way to take a loan to be able to accelerate your business. And so a little bit about me and the Capital Data Science team. I head up the data science team. We are hiring, so if any of you are looking, please talk to me afterwards. Started out my career, well, started out my studies here, actually at Cal, doing pure mathematics. My dad joked it was unemployable mathematics over at Evans. But the goal was really to pivot that into something a little bit more applied. And so went into data science and machine learning, and then ended up working, like most other people, in Silicon Valley and in technology, and then ended up at Square. And so our team really is focused on a couple of things within Capital. As mentioned earlier, default underwriting and macroeconomic risk. Basically, given seller data, can we predict the likelihood that a seller is going to default if we give them a loan? Can we also predict the probability that a seller is fraudulent, that they're not even a legitimate business, but they're a bad actor? They bought maybe 50,000 credit cards, and now they're looking to swipe them all through Square in a very short period of time. Also, macroeconomic risk. Square, founded in 2009, it's 2016, hasn't really quite seen a macroeconomic slowdown like the one we saw in 2006 to 2008. So how do we model the impact of a loan portfolio in a macroeconomic slowdown? What does that even look like? So that's one tranche. Second tranche, business operations and marketing optimization. Can we streamline the process to get a loan approved? We send an email out to a seller. Seller sees their offer. They click accept. Can we streamline that process from button click to money originated? Because it involves a highly complex dance of machine learning and human expertise in our operations team. And then can we market our loans to the right businesses at the right time? You would think for a product such as money, you can just sort of send an email to everyone and say, well, check if you want to take a loan. But actually, there's a very unique time that a seller would want to take on money or a loan, and that's exactly at the moment they want to expand their business. And so you can't just email them every week over and over again, because you risk fatiguing them, and there are a bunch of other products that might be marketable to a seller at the right time. And so determining when a seller is ready for capital and is actually at a very high probability to accept capital is part of our purview as well in data science. And then the third thing, moonshot research and product development. It's a very lofty term, but basically, in short, if you had 2 million sellers on our platform and you had card transactions for the last 6 years, can you use that data to accurately predict economic indicators? What products and things can you create with the data that we have that in turn serves our sellers? And so that's a much longer research tranche that we've been looking into and investigating. So before we even get into capital, a little bit on exactly small business lending in the first place and why it's quote unquote broken. If you were a seller and you started your business and you wanted to get a loan to maybe buy another pizza oven because you were a pizzeria, or another location because you're a coffee shop, going through the process of actually applying for a loan is actually a very horrendous process. You'll spend on average 24 hours. Assuming you're not discouraged from applying and you don't apply, you go through 24 hours of assembling the right PDFs, tax forms, income statements, and prior credit history, not just as a business, but as an individual. And so if you have no credit history because you just moved here and you wanted to start your business, or because of any other reason other than you just sort of lived your life, it could be very, very difficult to get a loan. And so I think what's unique about Square Capital is that if you already have been running your business for a couple of years on Square, you've already proven that you're able to run a business effectively. And so we should use that data to assess your eligibility for a loan instead of more traditional economic indicators such as a FICO score or what have you. And so just to summarize, we use real-time transaction-level data to build machine learning models to underwrite and risk assess, basically assess whether you're a legitimate business and whether you will default on a loan if we give you a loan. And the last part is that there's this economic empowerment narrative, which is actually central to the sort of DNA of Square. And it's this sort of narrative by which we extend modern banking services to the underbanked. I think it's somewhere around 60 to 65% of immigrants in the United States have less than $1,000 in a checking account. I think 30 to 40% of them don't even have a checking account or a bank account. And so of that segment, and this is the amazing part, 40% of them have a business. And so they're just a completely cash-based business. So how do we get that into a bank account that returns money, or allow them to basically manage their money more intelligently and introduce them into the modern banking system in a way that is holistically serving them and serves the business? And so here's basically what Square Capital looks like. It is a simple dashboard and an email you get from time to time. If you run your business for some amount of time on Square, let's just say a year, and you qualify for a capital loan, you'll see a page that looks something like this. 3 different offers, $10,000, $8,500, $7,000. And you click on the offer that you want, and then within 12 to 13 hours, you get a yes, no. And if you get a yes, then the money is originated to your account the next day. So the whole round trip is around 24 hours. The way in which we do this is we sort of pre-screen people first. You can't apply for Square Capital. You are qualified for Square Capital by just being a good seller on Square. But the repayment mechanism is actually quite interesting in that we don't actually require a monthly payment like most loans. We withhold anywhere from 9 to 13% of the transaction itself. And so the way we figure all this out is that if we know how much you've made in the past year or 2 years, we can forecast forward how much you will make in the next 12 months and then take the withholding rate as the monthly payment. And so that way, the user experience is very seamless. You don't have to worry about yet another monthly bill, and we can just withhold some percentage of your transactions to be able to pay off the loan in full. So in order to do all of this, we have to think about 3 different things for underwriting a loan. Questions of eligibility, who gets a loan, who doesn't get a loan, sizing, how much money should we offer them, and then pricing, what rate should we give them. Some constraints, we want to make sure we reduce our default rates when we give money. I mean, the quote is always, it's very easy to give money to people. It's always hard to get it back. And so you want to minimize the rate at which people default or just stop paying you on a loan. And we want to maintain, we don't want to maximize, we want to maintain investor returns to some strict band of returns. And this is actually quite compelling because if you imagine the first time anyone did this in 2006, the goal was to maximize returns outstripped. And our goal, because capital is actually part of Square, is not to single round cheat them out of a loan, but to make sure the loan actually grows their business. Because when they grow their business, they charge more credit cards through Square, and then it creates the flywheel in which we can offer another loan that is bigger than the last one. And so going back to this ecosystem, it's sort of this check and balance where if capital actually succeeds in growing a business, then you get to grow your business. And then it goes back into the transactions at the top, which funnels back into Square. And so it's this double bottom line where our goal really is to genuinely grow a business out at the same time by providing value-added services and products that make sense. And priorities. Interpretable, simple, stable algorithms. While we are investigating some of the more complex algorithms, maybe like a deep learning recurrent neural network or any of these very sensitive RFs or random forests, the problem with that is that they can be completely volatile based off of whatever features you put into it. On top of that, if you've ever applied for a loan or credit card and you've been denied, you've probably seen what's called an adverse action notice, which gives you maybe the 3 to 5 reasons why you weren't accepted for a loan or a line of credit. And so if you had something as opaque as perhaps like a neural network, it's extremely hard to actually get any human interpretability. And we can't tell a seller, you didn't get a loan because this black box said so. And so figuring out the intersection of algorithm and model that is accurate and human interpretability that a manual credit underwriter, an expert in the financial industry, can assess and come to the same conclusion is actually extremely important. And that's an additional constraint that most fintech companies ought to perform in, and some fintech companies do not operate in at all. But for us, it is a very huge priority. So to just go through a visual diagram of what this all looks like, let's say this is a field of sellers, merchants on Square, and each square is a merchant. Before we actually go into any capital eligibility, we'll run risk data science models on the actual merchants themselves to determine whether they are a bad actor or not. And so, for example, if you tell us you are a cafe in San Francisco, and 80% of your cards are coming from basically all around the world, you are either an extremely popular international tourist destination in Berkeley or a fraud. And so that is one of many, many examples and heuristics we put into our model where basically if you are 2 sigma in either direction in any feature that we monitor, you're flagged for manual review. And through that manual review process, an operations agent will take a look at the business and manually assess whether it's legitimate or not. So we can go ahead and remove those folks. We'll then assess your eligibility for capital. And so this isn't necessarily who's a bad actor. These are now, all of these squares now represent legitimate businesses trying to just make it. So in this case, the red squares represent businesses that either haven't been processing on Square for enough time or perhaps have a lot of volatility. Like if you were a food truck, for example, and you made $2,000 one day and then 0 for the next 14 days, that's actually quite a bit of volatility that an underwriting model wouldn't be comfortable with. And so for better or for worse, they are also excluded from eligibility. And so now these squares are completely eligible for capital. And we just now need to figure out what their probability of default is. And so we'll run them now through a default model. And the default model is, as I mentioned, it's a simple, stable set of algorithms that are also extremely human interpretable. And what you end up getting is this series of colors where, the dark, for example, the the darker the shade, the higher the probability that they will default, meaning that the lighter shades are the safer sellers on Square. And so once we actually calculate the probability of default for a loan, we can then size them appropriately. And so in this case, the darker squares might actually get a larger loan, while the lighter squares might get a smaller loan. The actual sizing of the loan is dependent on a variety of different factors, which includes your probability of default. But that's sort of how the process works within Square at a very high level. We assess your probability that you're actually a legitimate business. We run a set of rules through that set, the resultant set, to figure out who's eligible for capital. And then we'll run you through a series of machine learning models to establish your probability of default and then size the loan. And so that's sort of a one-off project for a data scientist. That data scientist could go through the entire data set, train, test, validate a model, figure out the credit mix and volatility, and then ship it. Once you do that, though, how do you actually update the model every once in a while? And how do you make sure that the current model represents the state of the world? So we can go a little bit into operationalizing a default model for Square Capital. This is a spectrum. And so if you imagine, this is a risk score from left to right. On the right side, you have very risky people. On the left side, you have non-risky people. You can sort of bifurcate the space of sellers into two buckets, approve and review. And in that review bucket, you could probably take one more called auto-reject. And you want to make sure that that top right quadrant is an experimental branch where you can vary the size of it to make sure that you're actually auto-rejecting the right people. So we have three buckets: approve, review, and then auto-reject. And so the goal here is to calculate the probability of review for a given loan. That is, if you are a merchant and you've been processing for 2 years and your payment distribution looks like this and you are a food truck, what is the probability that an operations agent, someone with years in the financial credit underwriting industry, would want to take a look at you? And once you figure that out, let's see here. Once you figure that out, you can then try to optimize for that score. And then it becomes this flywheel where, as you deploy a model, you get feedback from the operations team to determine whether the sellers that you've approved were actually the sellers that an operations agent would want to approve. And on the other side, for sellers that we reject, whether an operations agent actually would have rejected them. And so in essence, what we're trying to do is we're trying to calibrate the actual machine learning model to a human expert. And the reason why is simply because the goal of any of these machine learning initiatives at Square or in technology in general isn't quite to replace human beings yet. Until we get to a strongly typed AI, until we get to all kinds of different singularity type events, the goal is really to augment human intelligence. There's a lot of different features we can't instrument. There's a lot of different features we can't munge and engineer and transform that can accurately represent 100% of the world. What you can do is you can amplify or augment a human being's ability to process cases. And so if it takes you 5 minutes to assess whether a seller is creditworthy or not, then with a model, you can cut down that time to perhaps 2 minutes and then cut down the number of cases they have to review because the more obvious ones you can weed out automatically. And so that really is the approach we want to take at Square, where there are people who have spent decades outlining ways in which they can underwrite and assess creditworthiness for sellers. We don't want to throw that out the window just quite yet with machine learning, simply because we're trying to get the right machine learning features in place first to make sure that we can augment their own abilities. So in terms of actually operationalizing this on a cadence, so if you imagine, let's say in February of 2016, you deploy a model into our engine. And so the blue line represents just our raw data. And we suck it into this model, and we deploy the model results out into this risk engine on the bottom. Then you can imagine here, every month we can update the model as needed. And each slice represents the current state of the world. And so you can imagine this sort of monthly cadence where we take in new data that has happened from February to March, and then we retrain it, and then we deploy it in. And then once we deploy it in, we can monitor a whole bunch of different KPIs and metrics that we cared about with respect to forecasted defaults, IRR, the internal rate of return for the loan, the actual credit mix of the portfolio itself, and so on and so forth. So, all of these models are actually deployed and are scoring simultaneously. We actually haven't removed any model out of the running yet. And so in terms of actually decommissioning models, older models, what we want to do is by May, for example, we'll have at least 4 months of February's model, 3 months of March's, 2 months of April's, and 1 month of the newest May model. We'll be able to then score one seller with 4 different models to be able to assess how bumpy or how volatile the model progression has been over time. And then we'll also know, once defaults come in, exactly which model won out. Hopefully, the models improve over time. Once we've actually confirmed that, then we can actually begin to sunset February's model, and then hopefully by June, we'll be able to sunset March's model, and really get on this 3 to 4 month cadence of deploying a new model out into production. New model in that it's 3 months old, but has been scoring for at least 3 months, and then we sunset out the old one. And so basically, just to recap, we can take new data sources. We can take new signals, which are transformations of these new data sources, or we can just deploy new models. And I think, in terms of value, that bottom tranche is probably the most valuable in that if we can get new data sources about our own sellers, either data that we have about them through Square or third-party data sources that we can aggregate, that's extremely useful to us. If we can create new features, that's extremely useful as well. But the new models bit is basically just, if you imagine in Python, it's just yet another series of functions you just run them through. Like, that's actually the true commodity. And I think everyone talks about the arms race of, well, deep learning everything, random forest everything. And I think, part of the nuance in this conversation is that, well, yes, do try all of these different algorithms and models. But remember that, better data will always beat better models. Put another way, machine learning is literally garbage in, garbage out. So if you just feed it a bunch of bad data, there's no amount of ridiculously awesome machine learning that will get you any results that you wanted. So that's a really quick overview of how we train and deploy models and how we really assess sellers for Square Capital. In terms of looking forward, and that I did not mean for that transition, but in terms of looking forward and what actually is in store for Square and Square Capital, we recently announced our partnership with Upserve, and Upserve is another merchant acquirer / POS, literally a Square competitor, if you will. But their ability to basically entrench themselves in restaurants in the East Coast is something we don't have. And our ability to deploy capital with our set of models is something they don't have. And so it's a symbiotic relationship where we can grow our own business and our own data sources, and they can grow their user retention by offering capital to their sellers. And then there are different loan products we can explore. And so this is our contactless reader here. It's $49 or $1 per week for 60 weeks. So that is, one example that didn't work. Because if you are trying to legitimately start a business, well, $49 is actually a low bar. And so what we were trying to explore was, is there a way we can give a chip reader to new businesses that can't quite afford the $50, but can provide services and products rapidly and have them pay for it over time? That is an example that didn't work, and the right side is an example that is working for us. So all this is to say that we're rapidly experimenting in this space, and we're trying to figure out how to develop products and services that actually serve businesses and consumers in a holistic way that doesn't turn into a $1 a week for 60 weeks, simply because that actually is quite a bit of a high rate. So that's all I had. I wanted to end a little bit early just to open for questions, and I know I'm the last talk in the day, so I wanted to just sort of be cognizant of that. We are hiring. You can go to squareup.com, or you can email me, or send me a tweet. But thank you.
Thomas, thanks very much. That's great. OK, so we have time for 3 or 4 questions. I see hands going up here. Let's start right down here. Thank you.
Thanks for the presentation. My question was regarding false negatives. Mm-hmm. They're going to be definitely something which you would want to keep to the minimum. So what best strategy did you come up for that?
So false negatives in that they're not eligible for a loan, but they should have been. In that case, it is unfortunate, but at the same time, because they're not applying for a loan, you don't get this sort of insult where you think you're a good business, you apply for a loan, and then you get denied. You only get a Square Capital offer if we've deemed you to be creditworthy. And so I think it's definitely a missed opportunity for us. And we do try to calculate what we've missed with respect to new model deployments and for our manual operations team. I think the bigger focus on us is the false positives. Basically, if we give you money and we think you're good for it and then you stop, that's a much more visceral hit for us. And I think at some growth and some scale, we'll care about the ones we've missed.
Just right behind here, and then we'll.
Okay, I have two questions. One for business. Who are your customers? Why don't they go to traditional financial institutions to get money? And second is, do you use any model to predict your cash flow? And also, have you taken any actions to prevent default?
Yeah.
Yeah.
So in terms of the first question, the reason why a majority of our sellers don't go through traditional banking services and banks is because the application process is a big limiting factor for them. Either because it requires documents that they don't have, or it requires a credit history that they don't have. But the one thing that they do have on Square is their length of time in which they've been able to run a business. And so we're able to use that first-party data to say, you know what, you might not have a good credit score or a good credit history, but you've literally been running a pizzeria for 2 years, and it's been growing. And so we should trust you with capital. In terms of, I think that was your first question. Your second question was about cash flow. So in a way, if we capture 100% of your card transactions, and I think on the register app, you can also declare your cash transactions as well. That is cash flow modeling in a way, because we know all of your cash flow coming in. We don't know all your cash flow coming out, but if you're using the employee management and payroll services, we also know what you're paying for. But we could make some inferences based on the type of business that you say you are. If you're a pizzeria in San Francisco, that has a different cash flow model than perhaps a hairstylist in Idaho. So we're able to at least get pretty close to the cash flows without actually requiring a PDF or a connection into your bank account. I think publicly we've stated that we're under 4% in losses, and in our earnings call last week, we continue to maintain less than 4% in losses. To your third question about, remind me, it was defaults. So, post origination, if it looks like you're slowing down or you've stopped processing, we will contact you and just see what's going on. And in most cases, it's literally took a vacation or sales are slow. And so there really is no remedy in that situation other than to wait and see. And I think for us, we really want to make sure we keep the servicing, sort of light, simply because our goal really isn't to collect or recover as much as possible, but to make sure that we ensure that the business grows and thrives.
Okay, I'm going to take 2 more questions, and then I'm going to make apologies for everyone else. So we're going to take that one over there.
So you mentioned that there's an eligibility check to see whether you get the loan offer button, and then once you click on the button, there's like another check to see if you actually get the loan. Mm-hmm. Just wondering, why are there 2 checks? Is that more for like a customer perspective, or is that maybe more for like a volume perspective?
The reason why there's 2 levels of checks is for the exact same reason that you can't have a machine learning model predict everything. There are some bright line tests of eligibility that we do not want to broach. Like if a machine learning model says you have a low probability of default, but your actual your actual personal history is that you were a felon for financial crimes, that's probably something that will take over the machine learning model. And so,
have you thought about revising that?
We have thought so it's just financial crimes. We have thought about other crimes, and it's sort of this like problem of, well, we could have an experimental tranche for people who have committed financial crimes and then see what the default rate is. But in short, there are some very clear bright line tests that we want to make sure we check against and then apply the machine learning model.
Okay, so I saw 3 hands go up, so here's what I'm going to do, okay?
Yeah.
I'm going to ask for the 3 questions, and then you can choose to either answer all 3 of them,
Yep.
or 1 of them, or none of them at all,
Got
okay?
it.
So I know there was a question right here, so we'll go with that one. We'll go with gentleman with the blue shirt, and then the lady in the green. Okay, so 3 questions, and then it's your choice.
Got it.
Thank you. It seems to me that the business model of Square exposes you to the retail sector pretty heavily. So are you building into your model risk management or sensitivity analyses as to the economic sways? Because retail is very recession sensitive.
Okay, so your own risk management is one question. Thank you very much. Let's take that one.
David, mine will be the most interesting question. What are the challenges of the machine learning with crime data, for example, and data involving financial loans, for example, is that as you make them more human and smarter, they've been several articles on how they come across as being discriminatory, biased, racist. I'm just really curious if your company even considers that in the model, and if you avoid certain features that might make you appear like you're being discriminatory. Which is why I think this is a great question.
It's an extremely
Right.
Mine, I was going to come up after. I might have blinked and missed it, but in deriving your various models in February, March, and April, I probably blinked and mixed it. What makes you discard one? Does it require a default and losing money? Does it require a real pain point to evolve your model?
Got it.
And Thomas, feel free to, as I say, disregard any of them. I'll say I'll take it offline, wherever you want to go with it.
Sure thing. So the first question of macroeconomic risk and retail sector being super sensitive. 2 points. One is that we're constantly aware of where we are, and Square started 2009, and we're at 2016. We're a little bit mid-cycle, and we're sensitive to it. And so I think our thesis is that because we represent the bottom up of sellers and buyers, we're a lot more reactive to it. And so given that we run the machine learning models on a daily basis, if there is some economic or monetary policy or political outcome that sort of affects the day-to-day to the point where people buy fewer and fewer slices of pizza or cups of coffee, then the loan will resize the models will resize your loan and then make ineligible people who were formerly eligible. And so in that case, our thesis is that the actual buying and selling of goods and services represents a truer economic indicator than top-down employment indicators. That's how we view macro risk. I'm going to take the discriminatory part last because I think that is actually quite compelling. But in terms of how we know when we've won with a model, say we deploy a model in February, and then March, April, May, we develop a bunch of other models with additional features. By the time we get to June, we have 4 months of data on the February model. We know whether people are defaulting. We know whether, not just defaulting, but the actual repayment diagram of people's transactions. And so we'll be able to detect the health of a cohort over time. And so it really is a composite of science and intuition and gumption, where we have 4 months of data from the February model and about 1 month of data from the June model. And we'll take a look at that, and it'll be data scientists and operations people, and we will assess whether this new model that we deployed is very promising. To your point about discrimination in machine learning, this is extremely interesting to me, and this is one of the reasons why I joined Square. I think there was an analysis in Florida in 2001 where they were trying to determine recidivism in Florida state prisons. And what they basically realized was that if their model included zip code, well, zip code is a proxy for race sometimes simply because some zip codes have certain socioeconomic segments. And so I think we absolutely do not use any features that could ever betray geographic location or any of the protected classes. And we really try to make sure that that balance is achieved, where we want to be able to extend credit to people who wouldn't otherwise be accessible to it. But we also want to limit our own losses as well. And so that's a very tricky balance that we always have to be able to strike and be aware of, simply because other startups, other fintech startups will say, I've got it. We're going to use Facebook and LinkedIn data to be able to determine eligibility. And the sad part is LinkedIn is a very specific demographic. Facebook is a very specific demographic. And on top of that, it's self-volunteered data. So who knows how accurate it's going to be? And so I think with Square, we really are blessed with the fact that because we have your first-party transactions of how well you run your business, we actually don't care who you are. So if you can just show us that you can run a pizzeria for 6 months and it's growing and you're not, it's consistent, then you absolutely should get a loan.